Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
So now I feel like I'm officially back. In that, I know I did like one show 2 weeks ago, and then I think like one more last week. Those were like one-offs by definition. But now I'm officially back. No more vacation. No Azalea Festival, which is kind of like a staycation. But back to regular working hours. So the podcast is back, baby. It's good to be back. Wilmington Mortgage. This is the Tuesday edition. I am the aforementioned host of this podcast, Tyler Crawley, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down top stories impacting mortgage rates every single day when I'm not on vacation or at the Azalea Festival in 15 minutes or less. And I've almost like forgot the intro to the show. That's why I was somewhat chuckling there. But yeah, it's good to be back. And even better, I actually have some good news to report. I thought this morning things were not going to be going well by the end of Monday, and that is not the case. As we are approaching the bond market closing, the 10-year is actually down almost 3 basis points. We are under 4.3%. That is pretty awesome. This morning, I think at one point we were up 3 or 4 basis points. And a lot of it has to do with the U.S. announcement of the blockade of the Strait of Hormuz, which was announced on Sunday. And we didn't see a lot of movement in markets. And like I said, I mean, it's kind of surprising that markets are taking it this well. We actually got all the equity markets. I mean, we're up today. Dow was up 300 points. S&P was up about 70 points. And NASDAQ was up about 280 points. And like I said, we're looking at actually the bond market potentially doing us well. Mortgage News Daily had the rates, 30-year fixed, there according to their index, were unchanged for the day. So, I mean, a pretty good ending to the start of the week, considering many people thought that this news of a blockade was going to be bad. And here's why. So here's why I think why the markets are actually taking it pretty well is because at first, I'll be honest, it seemed kind of funny because, Iran has been saying, the whole argument and their power derives from their threats on the Strait of Hormuz, their ability to shut it down since the beginning of this war. And so that has given them a lot of power. And it seemed like what we wanted was the Strait to open back up. That's why Trump has said many a times, he wants the Strait to open back up. He wants oil and tankers and other vessels to be able to flow through it without any problems. And so now all of a sudden you have the United States saying they're gonna also block the Strait of Hormuz, which sounds funny. Like everyone was doing all these memes online, whether it was Blazing Saddles, whether it was that Colin Farrell movie. I think it was The Burgesses, where the guy has the gun behind Colin Farrell, and then he has the own gun to his head. And it seemed like it was like the sort of joke about someone, you're going to get fired by your boss, and you tell your boss, you can't fire me because I quit. Like, we're basically going to be doing what they're doing. But that's not necessarily the case. When you actually look at it, the reason why there could be some beneficial, while the market's maybe taking this in a good way, is that Iran, while blocking other ships from sailing through the strait, they've been using it to release their own ships. And so it's allowed them to continue the flow of oil, which is kind of important to them. They're sort of an oil producing country. And so they need to get the oil out there. And so doing a full on blockade. So we're going to block Iranian ships. All of a sudden changes the game big time for Iran, because now they can't make any money. And we know that they're already hurting because they're the largest state sponsor of terror. And so they have been spending a lot of money on other conflicts, sponsoring terrorist organizations that the U.S. and Israel have been fighting to much success. And so Iran's been spending a lot of money on that and getting no real return. And now they're fighting their own war. And so money is an issue. And this is going to block them big time. And so this potentially could make them more open to a deal. Where before it seemed like they sort of had the cards and, we're going to shut down the strait, but they're allowing their ships to move, us completely shutting it down so no one can get in or out. Iran ships can't move either. That's going to put them in a bad place financially. And how long can they go without being able to make money on their oil? And so that's, I think, why the market's maybe taking this as a potential win or a end to the conflict that brings Iran to the negotiating table and then could lead to the end of this war. Whether it's unlikely that Iran's going to surrender, but they could say, okay, let's go to the negotiating table and let's work out a deal. And the fact that they are running out of money and not being able to get any money in could definitely help with that. Interestingly enough, today, BlackRock, of course, that's like enemy number one, right? For housing. Everyone hates BlackRock for owning all these houses, even though I don't think they actually own houses. That's Blackstone is the one that owns a bunch of single family rentals. And BlackRock always gets blamed for that. Go online and type in like BlackRock and housing. People hate BlackRock. But they are a big player with regards to the financial markets. $14 trillion in assets, managing $14 trillion for their clients. That's kind of big. What's the U.S. economy? Like 35 trillion, something along those lines. So $14 trillion might be kind of a big player there. BlackRock, according to CNBC, BlackRock raised its outlook for U.S. stocks, reasoning that contained impacts from the Iran war and strong corporate earnings will create a favorable backdrop for domestic equities. Developments in the war had made BlackRock cautious on domestic stocks, but it said prospects for a lasting ceasefire now have strategists believing that the impacts won't be major. They said, quote, in a release, we saw two signposts that would lead us to re-up risk after reducing it a few weeks ago. First, tangible evidence of actions that would reopen flows through the Strait of Hormuz. And second, visibility on the lingering macro impact being contained. This comes as expectations for corporate earnings have climbed for both the U.S. and emerging markets for 2026, even since the conflict began on February 28th. Now, this was earlier today, so I'm not sure if they are, I would assume that they would be aware of this idea of a blockade on the strait. And so I guess they were taking that into account. I can't imagine they let a note go out. Like I said, this was news on Sunday. So the idea that they would release something on Monday and, not be aware of that for a company of this size and importance. So I'm assuming that they are talking about things easing up or even talking about the blockade itself. And so there is a lot of positivity out there that this strategy, which some would argue maybe we should have been doing this day one, instead of let them sort of run the narrative of shutting down the strait. We should have been like, all right, we're going to shut the strait down. And so we will see. But markets look pretty happy. Equity markets up, bond yields down. That's what you like to see. All right, now one thing you do not like to see as we are entering spring buying season is a not so great existing home sales report, which is exactly what we got on Monday. Existing home sales, according to the National Association of Realtors, were worse than expected. They were expecting a drop, but it fell even more. Seasonally adjusted sales fell to an annual rate of 3.98 million. That was a 3.6% drop from February and was the worst month since last June. So not quite a year, but we're getting close. Sales were also down about 1% compared to 1 year ago. This is supposed to be, if you remember, 2026 was supposed to be a better year for housing. And it looks like that is not the case. Not surprisingly, it was across the board kind of, not a bloodbath, but a down across the board. The Northeast was kind of a bloodbath with sales falling 8.5%, followed by the Midwest down 4.2%, South 3.1%, and the West 1.3%. Now, here's what's interesting. Despite the fact that we saw sales with a somewhat big drop, supply only improved slightly. Usually you see like kind of a big increase in supply when you see kind of sales drop. Total housing inventory rose just 3% from February to 1.36 million. That's the third straight monthly increase, but like I said, nothing huge. Month supply climbed to 4.1, climbed to 4.1, so 4.1 month supply, up from 3.8%. But that was the highest level since November, though still below historical norms. And we're going to talk about that in a second. Home prices continue to rise despite the drop in sales. Median existing home price reached $408,800. That was up 1.4% from 1 year ago and was the 33rd consecutive month of annual price gains. But inventory is the name of the game. So inventory levels are up significantly from COVID, but let's not forget that COVID, they fell to like, I think all-time lows, just absolutely historical lows. And so there's sort of this perception that, oh, inventory levels are back to good levels, almost too much. You know, you see these doomsday people tweeting about, oh my gosh, we've never had more sellers than buyers, or this is the biggest gap between the two, which of course it's not. 2008 was probably the biggest gap when everyone was selling and almost no one was buying. But the reality is that we still have an inventory issue. Lawrence Young, chief economist at the National Association of Realtors, addressed this, saying that inventory remains a major constraint on the market, noting that an additional 300 to 500,000 homes would be needed to bring conditions closer to normal. And so we're still having an inventory issue. And this coincided with an economic report from the White House out on Monday. It's a big report. This is just one sort of excerpt from it, talking about, now what's interesting, they did talk about mortgage issues with regards to DTI problems. You know, everyone thinks when it comes to buying a house that the down payment is the big hurdle for most people. That's not the big hurdle, especially because now with the conventional, you can put 3% down, 3.5% on FHA, 0% on VA, USDA. There's grant programs out there as well that can help you with the down payment. It's actually the DTI, according to reports, is the bigger issue with regards to stifling home ownership. I do want to get into that, but we don't have time to get into it today. I want to stick with the inventory issue. They wrote this in this White House economic report. It says, if home building and the growth of the single-family housing stock had continued at their historical pace instead of falling dramatically after 2008. So if we had just continued on that path. Because remember, during COVID, we got back to 1970 levels. It was the first time we'd done that since 1970. So even in that run-up of 2008, we still weren't building as many houses as we built right after COVID. So everyone thinks like it was this crazy building time. And we don't have time to get into the other arguments that exist. But it's important to remember that just if we had gone back to sort of a more historical kind of norm that we had been sort of like the 80s, 90s, and 2000s, we'd have 10 million more homes than we have right now. And so Lawrence Young saying like we just need 500,000, but they're saying we're 10 million homes short. Now, some people have said that it's 4 million, 5 million, it's 3 million, but we're still talking about millions of homes being short that we should have. And it's a big issue because let's say we were seated to see rates fall. Everyone points out, well, if rates fall, what's going to happen is home prices are going to jump up unless we have a supply to match that demand. If demand jumps and you have the supply, prices don't rise. It's basic economics, supply and demand. Demand goes up and supply goes up, prices do not go up. Prices only go up if demand goes up and supply stays where it is. And so, despite the fact that we have seen inventory levels rise, we are still not where we should be that would help people get into homes. So I'm glad that Lawrence Yun's talking about that and the White House is talking about that. That is very important. And I know it's crazy because people will say, like in Wilmington, they'll go, no, we're overbuilt. No, we're not. It's hard to say that around here. People get mad if you say that. All right, we got to go. You guys enjoy your Tuesday. We'll be back here Wednesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.